Welcome to The Explainer. Today, we're cracking open a book that's basically the Bible of investing, Benjamin Graham's The Intelligent Investor. And let me tell you, this is not about getting rich quick. It's about a whole new way of thinking, a framework for staying disciplined and calm when everyone else is losing their minds. You know, to really get this, we've got to start with a story you probably wouldn't expect. It's about Sir Isaac Newton. Yeah, the guy who figured out gravity. One of the smartest people who ever lived, and he got absolutely destroyed by the stock market. Think about that. He could map out the entire solar system, but the craziness of the crowd, that was a whole different beast. And this is how much he lost. See, back in 1720, Newton got tangled up in something called the South Sea Bubble. He was smart enough to get out early, doubling his money. But then he saw his friends getting even richer. So swept up in all that excitement, he jumped back in at the very top and lost a fortune. We're talking over $3 million in today's money. Ouch. And look, Newton's story, it's not a one-off. It's the perfect picture of what happens on Wall Street again and again. Whether it was the Roaring '20s or the dot-com bubble, markets have this habit of swinging from wild optimism to total despair, and it can trap anyone, even a genius. This right here is the problem Benjamin Graham wanted to solve. He realized that your success in investing has almost nothing to do with your IQ. It's all about having the right emotional discipline. So he didn't try to create a system to predict the market. Instead, he built a system to protect you from the market, and more importantly, from yourself. So where does Graham's framework begin? Well, it starts with a really fundamental question you have to ask yourself. Are you an investor or are you a speculator? Because trust me, how you answer that changes everything. I mean, look at how sharp this line is. Graham doesn't mess around. An investment is based on solid analysis. It promises your money will be safe and you'll get a decent return. Anything else, chasing trends, gambling on a hot tip, hoping a stock goes up just because it's going up, that's not investing. That is pure speculation. And you can really see the two mindsets here, right? An investor is asking, what is this business actually worth? Am I buying a solid company? A speculator is just asking, hey, what's the price going to be tomorrow? Can I flip this thing? One is buying a business. The other is just betting on a ticker symbol. All right, so how do we control those speculative emotions that get even the best of us? Well, Graham gives us this incredible mental tool. It's one of the most useful ideas in all of finance. He wants you to imagine that you're in business with a partner, and let's just say this partner is a little bit unstable. Let me introduce you to Mr. Market. Some days, he shows up at your door, just bouncing off the walls, totally euphoric. He'll offer to buy your shares from you for some ridiculously high price. But then, on other days, he's a complete wreck, convinced the world is ending, and he'll offer to sell you his shares for next to nothing. Now, here's the absolute key. You don't have to trade with this guy. Ever. You can listen to his crazy offers every single day, but 99% of the time, the right move is to just smile, shut the door, and ignore him. You only engage when his moods get extreme. You buy from him when he's panicking and everything's on sale, and you sell to him when he's delusional and offering you a fortune. And that's how you flip the script. Suddenly, Mr. Market's mood swings, his total irrationality, that's not a risk you have to worry about anymore. It's an opportunity you can take advantage of. His price quote is just his opinion on that particular day. It has nothing to do with the actual value of the business. You are in charge, not him. Okay, so if you're just ignoring Mr. Market's prices most of the time, how do you actually know when to buy? How can you tell when a price is a real bargain? Well, this brings us to Graham's single most important idea. These are probably the three most powerful words in all of investing. The margin of safety. It's so simple, but it is so profound. The idea is this. You figure out what a business is roughly worth, its real underlying value. Then you only buy it when the price is way, way below that value. That discount, that gap between price and value, that's your margin of safety. It's what protects you when you make a mistake or when bad luck strikes. Let's make this real with a classic example from Graham's star student, Warren Buffett. So back in 1973, Mr. Market was in a terrible mood about newspapers. The entire Washington Post company was being valued at just $80 million. But Buffett looked at the actual assets, the newspaper, Newsweek magazine, TV stations, and realized they were worth at least $400 million. Buying a $400 million business for $80 million? Now that is a massive margin of safety. So these are some big, powerful ideas. But how do you actually put them to work? How do you turn this into a plan? Well, Graham lays out a very clear path for what he calls the defensive investor, which is basically for the rest of us who aren't trying to be the next Warren Buffett. Graham gives us a super simple rule of thumb to manage risk. He says you should always have a mix of stocks and bonds, and you should never have less than 25% in stocks or more than 75%. And here's the quiet genius of that rule. It forces you to sell stocks after they've gone up a lot and buy them after they've fallen. It makes you a disciplined investor automatically. And really, the whole game is to put your portfolio on autopilot. Get your emotions out of the driver's seat. Automate your buying so you don't have to think about it. Diversify widely so that one bad company can't sink you. And for heaven's sake, stop checking your stocks every day. All that does is feed your anxiety. The whole point is to build a system that stops you from doing the one thing that kills returns. Panic selling right when Mr. Market is offering you the best deals. And that, right there, is the heart of this entire philosophy. It's a total shift in perspective. You've got to stop trying to control the market. You can't. It's uncontrollable. Instead, you need to focus all of your energy on the one thing you actually can control, your own behavior. So, in the end, this is the question that Graham leaves us with. Is your strategy built for real investing, or are you just watching the scoreboard? Are you reacting to every little price change, getting hyped up with the crowd and panicking with the crowd? Or have you built a sound, disciplined plan based on real value, one that's designed to reach your goals no matter what Mr. Market's mood is today? Answering that question for yourself, well, that's the first real step to becoming an intelligent investor.